If you knew Bitcoin was going to go up 2% a month forever with no volatility, neither you nor I would be in business, because all the conventional finance investors, all the conventional journalists, they would dominate the market. Warren Buffett would own all of it, and there wouldn't be an opportunity for us. So I look at the volatility as it's a challenge, but it's also the bug is the feature. And I say to people, volatility is Satoshi's gift to the faithful. He basically gave you the ability to rise to the top of your profession as an analyst, as a journalist, as a corporate operator, as an investor. And if the volatility goes away, no one cares about your opinion on any of this. It's like,
Michael Saylor starts with a fundamental idea that goes against conventional thinking in investing. Volatility is vitality. According to him, Bitcoin's volatility is a strength rather than a weakness. Bitcoin is able to perform better over time because of this price volatility. Saylor contends that investors seeking Bitcoin's potential must embrace its fluctuations, since the possibility would not exist in the absence of volatility. Bitcoin requires patience, according to Saylor. In order to capture a whole halving cycle, which is the shortest time frame in which Bitcoin's fundamentals might rise above transient noise and speculation, at least a 4-year time horizon is needed. Investors should ideally consider 10 years rather than months, he advises. We explain in this video why Saylor thinks that conviction, discipline, and time are more important than market timing. If you find value in this content, please take a moment to like the video, subscribe to the channel, and turn on post notifications for more videos like this.
My message is, if you have a 4-year time horizon or longer, if you have money you don't need for 4 years, and you don't want to take any counterparty risk to a currency, a country, a company, a culture, a competitor, then you buy Bitcoin. And if you're an equity investor, and if you want amplified exposure, if you want to invest in the future of digital capital and the future of digital credit, and you're enthusiastic about, we think we can sell a treasury credit product that's really compelling and very interesting to 1 billion people, right? 1 billion people would love to have a bank account that pays 10%. If you would like to invest in that future as an equity investor and you don't need the money for 4 years or longer, then you can hold the equity. If you need the capital in the next 4 years, then you probably want to be a more risk-averse investor. You need to look at a credit instrument. And if you need exactly down to the penny, $87.17 in 2 weeks, you probably want to put your money in a bank or a money market, because that's just what you need. And so I think every investor has to decide what's their risk tolerance, what's their time frame, and are you a credit investor, are you a capital investor, or are you an equity investor? And then once you've made that decision, you can decide how to allocate your portfolio. As I say, volatility is vitality. Bitcoin is a volatile asset. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. If your time horizon is less than 4 years, you should hold the credit instruments like digital credit. And if you're an equity investor in a digital equity like my company, you need that same 4 to 10-year time horizon. 4 is the short term, 10 years is the long term. I'm an officer of a publicly traded company, and what are we doing? We are in the business of buying a high energy, highly volatile asset and stripping the risk and the volatility off of it in order to sell it to people that are much more risk adverse, that are much more volatility adverse, that just want that yield. And so if Bitcoin wasn't volatile, it probably wouldn't be high performance, and then our value added wouldn't be that great, right? Like, for example, I say to people, if you knew Bitcoin was going to go up 2% a month forever with no volatility, neither you nor I would be in business, because all the conventional finance investors, all the conventional journalists, they would dominate the market. Warren Buffett would own all of it, and there wouldn't be an opportunity for us. So I look at the volatility as it's a challenge, but it's also the bug is the feature. And I say to people, volatility is Satoshi's gift to the faithful. He basically gave you the ability to rise to the top of your profession as an analyst, as a journalist, as a corporate operator, as an investor. And if the volatility goes away, no one cares about your opinion on any of this. It's like, you've got fire, and we've got the phrase burned. Fire burns you and electricity shocks you. And Henry Ford created an automobile, with a burning engine, with a fire in the engine. And we created electronic transmissions. And so you put electricity and fire in the car and you've got a killer consumer product. And I think the key here is you got to look at this market and say, this is indicative of energy. You can harness the energy. You can't be scared of the energy, right? There are those people that run from the fires, and then there's people that put the fire in the automobile or the jet airplane. And we kind of need the people to build the airplanes and build the automobiles if we're going to move the civilization forward. So the volatility comes with the territory.
According to Saylor, any short-term price volatility is entirely outweighed by this long-term macro trend. Daily fluctuations in the market may appear spectacular, but when compared to the consistent structural uptake of Bitcoin, they are really background noise. The asset's expanding basis is the true narrative, not its volatility. He then simplifies the data to allay worries regarding MicroStrategy's dividend commitments. The corporation distributes dividends of almost $2 million per day. That sum is a very small portion of the total market liquidity when compared to the $100 billion daily trading volume of Bitcoin. In fact, MicroStrategy could continue to pay those dividends indefinitely even if Bitcoin grew at a mere 1% annual pace.
The company, if you think about it, we have a dividend obligation, and the dividend obligation works out to about $2 million a day. $2 million a day works out to 5 basis points of our trading liquidity. So let's say if the stock is trading above 1 times MNAV, then you're talking about a 20th of 1%. It's like nothing. But let's go to the situation where the stock falls below 1 times MNAV, and we don't want to sell the equity. We can either sell the commodity, Bitcoin, or we can sell derivatives on the commodity, or we may even sell derivatives on the equity. But let's put that in perspective. Bitcoin's trading $100 billion a day. $2 million works out to, it's like 2/100ths. No, actually, it works out to 1/5 of 1 basis point of all the trading of Bitcoin each day. It's like, it's not 1% of 1%. It's 1/5 of 1%. It's so small that it would pop up in the 5th significant digit, as a rounding error. So the company's dividend obligations are fairly de minimis. You can literally calculate them on our website. I think if Bitcoin goes up 140 basis points a year, we can pay the dividends forever and generate shareholder value, right? It's that small. And if Bitcoin goes up 0% a year, we have capital for the next 70 years. And in 70 years, we'll have to figure out to do something different. And we'll figure out what we're going to do to deal with it. But the company's financially very, very strong. And we have a huge number of financial options at our disposal because we are an operating company, and any of them could be used if we needed to. But what I would say is, over the long run, it doesn't matter, because over the long run, this will create near-term volatility. But if the world wants a bank account that pays them 10% rock dividends, and if Bitcoin is digital capital superior to gold, then it's not going to matter what an equity index allocator decides. If the insurance companies don't want to buy Bitcoin and the banks don't want to buy Bitcoin, or the index allocator doesn't want to support a digital treasury company, the free market is going to allocate capital and it will adjust. It just creates a bigger opportunity for some other equity investor that will pile into this particular asset class and support these kind of companies. So it is what it is. It'll work itself out. I think whenever there's a lot of volatility in the market, and right now, clearly we've had a lot of volatility of late. We're living through about a 35% drawdown. I remember what it was like when we had the crypto winter and there was a 75% drawdown. When you have a massive drawdown, everyone looks for a reason why. and they will grasp it. Is this the reason why? Everybody wants a reason for to explain their pain or the storm or the volatility. Is it the crypto exchange, liquidation bots, or is it this, or is it that? At the end of the day, if you look at the chart of Bitcoin for the past 15 years, there's 15 major drawdowns. It always comes back to an all-time high. There's 5 brutal pullbacks in the past 5 years. This is not the most brutal. All of those things have happened without the support of the politicians, without the support of the banking industry, without the ETFs, without the IBIT derivatives market, without the support of MSCI, without the support of the S&P index. I could go on and on and on. The reason that digital assets are spreading around the world is because there's a billion people. They want to hold the money in their hand. They want to move the money at the speed of light. They don't want to be dependent on 20th century financial structures. They don't trust gatekeepers. And they would like to move forward with their lives with some control, with financial freedom and sovereignty and property rights. And those fundamentals are stronger than ever.
According to Michael Saylor, there are a lot of misconceptions regarding the company's dividend commitments. He explains it in a really useful way. The daily dividend payments from Strategy total almost $2 million. This amounts to a negligible 5 basis points when compared to the company's total trading liquidity. There are numerous possibilities, according to Saylor, even in situations where the stock trades below its net asset value and the business decides not to issue or sell shares. Saylor compares the dividend commitment to the $100 billion daily trading volume of Bitcoin to put the scale in context. In light of this, $2 million is so tiny that it hardly appears in mathematical calculations. He characterizes it as a rounding error rather than a significant expense. According to Saylor, the company may continue to generate shareholder value and pay dividends indefinitely if Bitcoin increases by only 1% annually. Strategy would have enough money to cover its debts for decades even if the price of Bitcoin didn't increase at all. Saylor highlights that Strategy is an operational business rather than a passive holding corporation. Strategy utilizes its capital to build digital credit and Bitcoin-backed treasury products, just as banks use capital to produce loans and insurance companies use capital to form policies.